welcome back everyone to another episode on Ang's stock review. Today we have another stock from Russell 2000. It's called the Accel Entertainment, and the ticker number is actually ACEL. It's called ACEL. So without further ado, let's get right into it. Over here on the chart, we can see a slightly overall in the form of increasing trends. However, it's actually slightly slow, and you can actually observe a very consolidated and sideways movements for the price range of this company. And if we go back and look at a bigger picture for a weekly chart, you can actually see this company, since its launch of IPO, this company has been in a state of consolidations and sideways for quite a long time. And it's actually, for me, in my view, is that this company, this price reactions is sort of suitable if you are trading in terms of range. So you just buy at the lows in this range about $9 and sell it at the high range about $12. You probably be able to make a 30% from your portfolio or the invested amount. So without further ado, let's get right into their financial status. So over here we have the revenue for our Accel Entertainment, and over here we can observe a increasing value in terms of their revenue, signifying the great sales in terms of what they are doing. As for their net income, it is to understand whether or not if they are being able to generate cash flow as well as profits from their revenue being generated. And as observed, the value on as well as the trend is kind of like in the form of decreasing, as you observe, starting from 2022 until 2025, and showing a low predictability for this net income, indicating that despite having increasing revenue, the company does not actually earn a lot and has fluctuating net income with a sort of like decreasing trends, and maybe will affect and also show that the company profitability or the ability to profit and gain cash flow is sort of in the weak side. As for the free cash flow, we have the Accel Entertainment also being able to provide a very high in terms of free cash flow, but sort of like in the form of decreasing, as this is kind of like understandable because this might be a result that is led by a decreasing in terms of net income, which is reducing the profit margin despite having a lot of revenue, but they profits less from what they actually do or sell. So now let us look at into details that what does this company actually do. So it's actually a US based distributed gaming operator specializing in providing gaming and entertainment solutions to authorized non-casino location. So basically they partnered with businesses such as bars, restaurants, convenience stores, truck stops, and other stores to offer a range of gaming service, including video gaming terminals, redemption machines, and amusement device. So their main streams of income is basically they sell video gaming terminals, with which they actually partners with the stores, the restaurants, the bars, the non-authorized stores to provide a simple gaming facilities. So they place the electronic gaming machines in bars and so on and so forth, and comes from a percentage of the wagers or the net gaming received collected from the players. So they also charges for the service and support fees, including the installations of the gaming facilities. They provide maintenance, technical supports, and they also has license and compliance services. So they help those stores in order to obtain the regulations or the license required to own that gaming operators for their partners locations. So basically what they provide is in terms of gaming facilities, including like games terminals, game operators for non-casino stores like bars, restaurants, and also provide, instead of selling them, they also provide ongoing services, installations, as well as helping the stores or partnerships in order to obtain a license to properly own the gaming operators inside their stores. Now for their strength is that they have market leaderships in Illinois and hold approximately 55% of the Illinois distributed gaming markets. And they also have diversified revenue streams. They generate 68% from the gaming operators and get 20% from equipment and 12% from interactive gamings. And they also have technological infrastructures whereby they utilize a proprietary gaming management system that monitors all its terminals in real time and also experience in management. As for their weaknesses, it's very concentrated in terms of their geographic, meaning that 85% of the Accel's operations are in Illinois. So they are the head and the leaders in of this market, in this field, in that specific place, but it's just too concentrated, and they could have be better off to expand their business, to include their business all over US or even global, as to increase their revenue as well as profitability and raise their net income if possible. So for their regulatory risk, they face potential legislative charges such as increased gaming tax rates. They also have operational costs whereby high maintenance expenses and also have limited international presence. So based on the previously observed net income as well as free cash flow, we observe a decreasing trend. So the mentions, one of the primary attribution is going to be their change and losses from their fair value of contingent earnout shares. And as for the free cash flow, is due to the increase in terms of their capital expenditures, and also that is the reason behind why they have so low in terms of their ability to profit from what they actually do. Moving into deeper, knowing this company is actually providing sort of like a gaming operators for stores and restaurants, but I do have a questions in mind, is that if this is still a standard or solid business model to have in this very competitive market, because for this youngest generations, alpha and so on, we have phones, we have gaming consoles, Switch, we also have PS5, we also have Meta, which provides in terms we also have Meta, which provides in terms of virtual reality gaming and so on and so forth. A mobile console in terms of gaming is become more and more advanced, and you don't even need a gaming console in order to play games at all, because you have phone, and phone right now are more sophisticated, whereby iPhones are made thinner, and we have phones that has more screens and so on and so forth. So in terms of this stock price right now, I would see that the price ranging and reaction from this company is actually showing a decent return from the company, but with at least showing that this business model will continue to hold its positions. It also starts to show its ability of expansion to other states and also include all US. They might be able to have the ability to increase their revenue, as well as this to improve their profitability as their business actually grows over time. Right now, the situation is by the company status is not that bad. It's just that it's in a form whereby it starts to decreasing, starts to raise concerns if no further actions or future outlooks to improve their business model is being made. So let's go into the ratios, whereby we have the debt equity ratios at 2.28. So this is actually terminates my rule whereby I don't want a debt equity ratio greater than 1. So this is very dangerous to own. And as for the ROE, we have a ROE actually close to 15%, but you can actually observe a trend of decreasing ROE, which showing the sign of, hey, if this is predictable, in the future, it will start to decrease even more and decrease until below 15%, which is not ideal for our long-term holding buying strategies of buying high-quality companies. So similar idea for ROIC, slightly slower decreasing rate, but at a rate lower than 15%. And lastly, we'll be looking at the balance to look at their total cash, net cash. So it is actually in a negative form, whereby they own a lot of debts more than their cash, which can also be observed from the high value of 2 in terms of their debt to equity ratio. Now we'll be looking at their economic moat score for the Accel Entertainment. and you can actually see the Guru Focus is actually rating the company as 0 mode, and for AI summary of their modes, it's actually at 4.0, which is actually a very weak and narrow mode, and show a weak structural competitive advantage and lack of branding powers, consumer stickiness, as well as network effect. So after looking at all the criterias, we're not gonna further deeper into learning the company, because from the summary over here, we can actually conclude this company is a low mode with probability of the net income continue to decreasing until they show a sign of changing business model, or even expanding their business to different states, whereby there is a chance and potential in terms of increasing their overall sales and revenue, and perhaps increase their net income. But the fact that we observe from the net income perspective, the decreasing form of very low predictability shows the low profitability skills of this company, as well as their low free cash flow and high debt situations, which turns me down in terms of investing in this company, as well as its low mode of 4.0, as well as 0 from Guru Focus, which makes me even want to just cancel out these stocks from my list. So I guess that is all for today's video. This is a stock with low mode, and I do think that there are more business competitive advantage in terms of mobile phones, as well as mobile gaming consoles, including Switch and so on. This is just not the trend right now, especially in this AI major, and starting converting into robotics field in the coming future as well. So I guess this video helps you, and if you want to support me, you can click the thumbs up, subscribe to my YouTube channel, and share this video if you want. And I hope to see